Thanks for clicking. All eyes were on Stats Canada this morning as it was set to release Canada's inflation data for the month of May, with the big six banks expecting a major slowdown in our CPI down to 3.4%. We got our answer at 8:30 this morning when Canada's inflation data came in at 3.4% in May, matching expectations.
The market is shifting already.
And while word that Canada's inflation rate has slowed will no doubt be welcome news to many, especially after hotter than expected inflation data last month preceded the Bank of Canada resuming its rate hiking cycle, many are pointing out that this by no means indicates that the Bank of Canada will be holding off on further rate hikes going forward. And the reason for this sticky inflation and the incoming rate hikes, say many, is Canada's money supply.
What the is that?
So what I want to do today is go over the inflation data for the month of May, take a look at why the Bank of Canada may still be raising rates in July, discuss Canada's money supply, and then go over what to look for next. Speaking of next, the end of the month is upon us, and we are eagerly awaiting the release of June's real estate data coming out from the local boards. Given that the hot real estate market contributed to the Bank of Canada's decision to raise rates in June, the release of June's data will be particularly timely. We'll obviously have updates out on that data on this channel. Click like and subscribe if you want to get those updates, but for now, let's get into this inflation data. Onto the data. As mentioned, Canada's inflation data in May came in as expected at 3.4%. The slowdown in price increases in May were largely driven by a major reduction in gas prices since this point in time last year, and the mortgage interest cost represented the largest increase in the CPI. If we exclude mortgage interest costs from the data, the CPI came in at 2.5%.
Yeah, I have an idea.
Indeed, as a side note, I think we are going to hear more and more of those arguments coming from the usual suspects that the Bank of Canada is contributing more to the inflation rate, more to the mortgage interest cost than they are actually helping. But I do think, as evidenced by the Bank of Canada's summary of deliberations released last week, that the bank is concerned that if rates were to go lower, that the housing market would reinflate, which would in fact put more upward pressure on inflation, leading the bank to have to keep rates higher for longer. But I digress. Regardless, measures of core inflation also slowed in May. Core inflation strips out more volatile items like food and gas, and are the measures the Bank of Canada looks to when deciding whether or not to raise or lower rates, and core inflation also slowed in May, though not nearly as fast, with measures of CPI trim and median dropping below 4%. So, nothing really surprising coming out of this month's inflation print, not like last month, which was a big surprise to the upside. This month, we have prices slowing down to 3.4%, which was widely expected, as gas prices have slowed significantly since this point in time last year. And yet, even with the pace of Canada's price increases slowing to below 4%, it's not clear that the Bank of Canada will be able to pause on rate hikes. Again, James Orlando, Director of Economics at TD, said that although he was optimistic that the CPI would come in below 4%, the Bank of Canada was still likely to continue with the rate hikes as Canadians are continuing to spend. Indeed, in its summary of deliberations just released last week, the Bank of Canada said that one of the major reasons for the increase in interest rates that we had a few weeks ago was the surprising continuation of consumer spending.
You never do anything to simplify my life.
And that rate hike coming from the bank, caused by consumer spending, came before last week's Stats Canada release, which showed consumer spending had picked up by 1.1%, far outpacing the 0.2% estimate. So consumer spending, at least for now, appears to be resurgent, with many households shrugging off the higher cost of borrowing. And two recent articles coming from the Toronto Star and Better Dwelling point out why this might be the case, mainly a major increase in the money supply over the past couple of years. The article in the Toronto Star looks to John Maynard Keynes, one of the most world-renowned economists of the 20th century, who, in 1919, said that various belligerent governments, unable or too timid or too short-sighted to secure from loans or taxes the resources they required, have printed notes for the balance. Keynes, at the time in 1919, was talking about the governments that funded the World War I expenditures through money printing, which led to a 1,500% increase in the cost of living in Austria-Hungary. So governments, in times of crisis, did not secure the revenue they needed through taxes or loans. Rather, they printed new currency.
Why not?
Keynes was writing in 1919, in the aftermath of World War I, 101 years prior to 2020. And I can almost 100% guarantee that the central bankers, those who guaranteed that rates would remain low until 2023, have most certainly read and are well versed with John Maynard Keynes.
Well, that must be nice.
And those same central bankers dramatically increased Canada's money supply throughout the pandemic. Now, the article coming from Better Dwelling does point out that the pace of the growth of Canada's money supply has indeed been slowing over the past year. And indeed, that does look to be the case. If we look at the Bank of Canada's website, we can see a massive upsurge in the amount of money circulating in Canada's economy in 2020 and 2021, hitting a high of 14.3%. Then that starts to come down, and now, as of March of 2023, we're only seeing a 2.1% increase in Canada's money supply. So, the amount of money in circulation in Canada's economy is still increasing, though at a much slower pace than it did over the past few years. And while all of that money that was printed or created in 2020 and 2021 is out there circulating, out there spending, the Bank of Canada has no real immediate way of getting that money out of the economy, with, of course, the exception of maybe selling off all of the bonds that they purchased with their printed money. However, were they to do that, bond prices would plummet, yields would surge upwards, as would mortgage rates. Granted, there is indeed a lot of money being pulled out of the system right now. Ask any holders of variable rate mortgages with adjustable payments. A lot of their money is going to the banks. It's not going into services. It's not buying goods. With that said, the Bank of Canada, as demonstrated by its balance sheet, printed a lot of money during the past few years, and it's going to take some time to get that money out of the economy. The data points that we're receiving from Stats Canada showing an increase in consumer spending shows that there's still a lot of money out there. And it makes sense. If we take a look at the Bank of Canada's balance sheet, if we take a look at Canada's money supply, we can see that there was a lot of money created, a lot of money injected to the economy, and it's not clear that the Bank of Canada can get all of that money out of the economy in short order. So while today's news is definitely good news, inflation is moving as expected in the right direction, below 4%, there are still a lot of pressures out there. There is still a lot of money out there, money which continues to spend, and money which continues to put upward pressure on the inflation rate. And as such, it's not clear that the Bank of Canada is going to stop its rate hiking cycle anytime soon. With that said, we will continue to track Canada's inflation rate and Canada's economy and the Bank of Canada's responses stemming therefrom. If you want to get those updates, make sure you click like and subscribe. But for now, thanks so much for watching.